um, we've hit an inflection point, in my opinion. And from this point, over the course of the next week or two, I think with where the market stands, and as I go through this, the market has basically now reached a point where this is going to start to accelerate in terms of news on the unintended or the intended consequences from the tariff situation. So, this whole video is about making sure that we pay attention to the fact that it's a levered Ponzi scheme. And right now, the deleveraging, which is happening each week, is starting to impact liquidity. It is starting to cause more pressure on the administration in terms of coming to a quicker decision, whether it's the economy, whether it's the market's expectations of inflations from the tariffs. Multiple points of the economy are starting to get weaker. And so I want to go through that and just, towards the sentiment has obviously continued to worsen. But I had a lot of conversations this week, and I think people are getting too much into where the economy is going to end up extrapolating the tariffs, and we're still in a point where you have to put probabilities on whether the administration is going to be able to keep continuing with this, or whether, as I'm saying, their pressure is building for an off ramp. So we'll go through this one by one. For the week, S&P was down 1.5%. Quiet week after the last two ones, so things had kind of settled down. Same thing went for the bond market. Yields did come down after the historic rise last week. It was, lower volatility, and we came down 16 basis points. Same thing goes for the currency market. Dollar remains weak, but last week we had that historic fall in terms of Treasuries. I did this chart to just show that Treasuries in euro terms. So if you're a European investor that invested in long-term Treasuries, you were down 10% in a week. You can see, where that went. But this whole thing of dollar going lower with assets going lower, the dollar has been a major part of this. So B of A came out with their fund manager survey. Investors haven't been this bearish in 30 years. Here's basically their sentiment measure when they combine growth expectations, cash, and equity allocations. And Michael Hartnett basically said, now contrarian trades are long U.S. stocks, U.S. dollar, global cyclicals, short gold, bonds, defensive. So if this is where everyone is positioned, we have to spend time on, again, what started last week and what I'll continue to say. The administration, and in particular Scott Bessent, who seems to have moved to the front seat of the car while Howard Lutnick and Peter Navarro have moved to the back seat of the car. Bessent on Monday gave an interview in Buenos Aires. If you haven't watched it, it's worth watching. I think every time he speaks now in long form, more than 10, 15 minutes, you want to pay attention to what he's saying. But he basically said, if we measure uncertainty by the VIX, I don't want to make market calls, but it seems the VIX has spiked and likely peaked. Well, that would be an indication, again, from the administration that the second derivative of policy has shifted, and they've acknowledged that the unintended consequences of the market probably got away with them, and the reason is because of the Treasury market. And so he did say in there, in that interview, that Treasury could increase buybacks of off-the-run securities if needed to stabilize markets. The reason this is important, and it was reiterated the next day from the deputy secretary. This is just Bessent again. It has a toolkit specifically if needed, and then Michael Falkender spoke again on Tuesday after that interview, basically talking about how they are discussing the supplementary leverage ratios application. The reason this is important is because at the end of the day, if they do things to slow the economy, as I've said repeatedly, they're going to have to come in with some sort of liquidity. Once they start providing liquidity to the market knows that they're going to try and do something where they're going to provide money to keep things stable. And I think you should realize that is what has to happen with leverage and debt to GDP this high, is that if you're going to do things that freeze the economy, like it was in Lehman, like it was in COVID, like it was briefly during Silicon Valley Bank when deposits were leaving, they have to create liquidity facilities or come up with something. Everyone's focused on Fed rate cuts. That is totally irrelevant. We're at the point now where, in my opinion, the printing press is being revved up, and that's why you have to pay attention to what Bessent said. The reason the printing press has to be revved up is that money's leaving the system. So just like if it was money leaving a hedge fund that has quarterly quarterly liquidity, the market is seizing up as we speak. When the top end of the capital structure has no liquidity, you have to go through and look all. Well, if people want to sell something right now, there is no liquidity. So Mohammed El-Arian put this out from the FT article. Liquidity worsens in the 29 trillion Treasury market as volatility soars. Analysts as JP Morgan said market depth, a measure of market's ability to absorb large trades without significant shifts in price, had significantly worsened this week. This is where we are. It's showing up in all parts of the market. If you need to move a lot of money and there's something going on, which is when people typically need. So if the U.S. says they're breaking off conversations with China and $10 billion comes to the market, there is no liquidity on the other side at this point. So having grown up in emerging markets, when the tide of liquidity goes out the door, or if you're in a movie theater and someone screams fire, the door has gotten very close, very small right now for people to get out. So how important is the Treasury market? It provides the benchmark risk-free yield curve for pricing risky assets. So if that's not there, then this is what happens. Loan and bond markets sealed tight by the tariff. So you get to see the issuance in leverage loans. That was an FT article. U.S. leverage loan issuance drought is about to set a record. It did set a record, longest run of having none. And junk bonds, one deal since April. There were two deals last week in terms of buyout deals. The banks got hung with the debt. Sometimes the music just stops. That's what's happening. Is liquidity is falling off. Torsten Slok put out this. Just the gap between liquid and illiquid bonds is particularly noteworthy. In 2020, the bid-ask spread widened across the whole market, but this time around, transaction costs have increased materially more for off-the-run paper. You're basically, this is in the IG market. Remember, this was a historic situation, and this is what's happening now. So you're seeing this across the marketplace. In the S&P, median S&P stock bid-ask spread has gone up to COVID levels. Russell 3000 liquidity, and the overnight repo facility drained this week. We finally got down. We've been doing QT. You've been having money leave. The demand for cash is getting higher and higher, and it's getting harder and harder to find. And swap spreads, which had this shocking move last week, have sat down there. So you haven't had the repair. Things have just calmed down. In terms of the tariff week, I'm not going to go through all these in details because it's just a constant back and forth. They're clearly using great deals as a way to keep people from selling. As of right now, it's working. But now it's becoming, okay, show us a deal. We're getting sick of words. And I think that's where the market was on Friday. You would think that going ahead of a 3-day weekend where this was kind of thrown out there, that the market would rally on fears that there'd be positive news. This was a massive trend that went on during the great financial crisis, as people thought there'd be a bank bailout every single weekend and positive news and new stimulative measures. So the market would trade up into Friday and then sell back off on Monday and Tuesday. We didn't get the rally on Friday. We are significantly still off the lows, but it was a little surprising, and it just shows the fact that buyers are not even coming to cover shorts at this point, which we have a lot of shorts out in the marketplace. Just in terms of, if you didn't see this on China's white paper, I just think it's important to recognize that I do think that there's a high probability of an off-ramp that is going to happen, and I think they'll find a way to get something done, but it's kind of in China's hands at this point as to when it is and whether they want to extract more pain, because I think the short-term pain right now of the U.S. market is starting to show up. It is showing up in China too as I go through this, but I think if they wanted to take this to the very end, they're going to have to come up with some hope in the marketplace and a pause, because each day that the tariffs at the level they are, it's starting to put businesses out in both parts of the world. The repercussions of the strategy are going to take months to come through, and that's really what it is. If these tariffs stay at these levels, as I go through the details, you're already seeing the trade situation spiral. And so you will start to get some job losses. I think that's going to show up, and that'll start to freak people out, the inflation side too. Charles Gasparino and people that I think would, are heavily in the camp of Trump, you're getting more and more pressure, more and more them saying that the way they're handling this is just wrong. And I think that's become the common belief is people that were very much in favor of redoing trade have become more negative on the whole situation, and you're starting to get pressure on all sides. One thing that was evident to me, I went to 2 breakfasts, 2 dinners this week, and the sentiment from macro people is just outrageously bearish at this point. And I just wanted to highlight, this was this week's podcast, just from this week that I listened to, and you can see, I mean, it's basically a end of the monetary system, death of the U.S. Everything is about kind of this whole thing of looking at the globe and deciding that the end is here. And I just want to remind everyone that this is exactly what the administration planned to do. They told they were going to do. Stephen Mirren here, who was interviewed in Bloomberg Television, is the architect of this entire thing. And if you forgot, here is an excerpt from his paper from November. And if you basically go through it, sweeping tariffs from strong dollar policy can have some of the broadest ramifications of any policy change in decades, reshaping the global and trade and financial system. So when you go back to those podcasts and you listen to them, this is what was intended. The intended part was to redo trade because it was unfair. So to say death of U.S. exceptionalism, this is going to lead to massive outflows that'll continue. Over the course of the next 5 years, do I think the dollar is going to continue to weaken? Yes. Do I think stocks in the U.S. are going to underperform Europe continuously for 5 years? No. And I don't think this is the end of U.S. exceptionalism. I do think that this was a mispositioning relative to the extreme nature of what they said they were going to do. This one is either there's a path by which these policies can be implemented without material adverse consequences, but it is narrow and will require currency offset for tariffs. So there is a currency offset. The reason that's important, with the dollar going down, we might have adverse consequences. The question is, are they going to let them become material, or are they going to let GDP come down by 1% or 2% for the year, front loading it to where it's going to be down 3 or 4% in Q2, because we're going to have significant drawdown. I'd be shocked if we didn't have a negative GDP print in Q2 because things are frozen. But people are still spending money. You're not seeing it show up. There haven't been job losses yet. So as of right now, they have the ability to walk stuff back. What I was saying at the beginning is the pressure to me is growing as I go through this. Dollar's persistently overvalued. We're taking care of that. You haven't had a significant move in the yuan. So the dollar is weakening. It's not weakening versus the yuan, but the yuan's also not weakening, and they're not letting it weaken at this point, which I would say is a positive in terms of adding more pressure. Everything that was said in here has been done. I do want to just highlight that Stephen Mirren is not making the final decisions, and just listening. I hate listening to economists and people that, I think these are just highlights from that interview. 3/4 of jobs created, sort of government expenditures. That's a bunch of BS. Every time I hear this on the All In podcast and everything, it's not government expenditures that have people in this country, 70% of them either pre-diabetic or obese. We need more nurses. We need more healthcare jobs. And yes, they are subsidized by the government, but that's the way the country is. So to include that in there and say that we're going to get through this, that is both a positive for why we're not going to see the job losses that we have in the past, because they are still going to be creating quote unquote government jobs, because the Medicare and Medicaid is not going away to help pay for those, but they include it in there. And I don't think there will be there's going to be material short-term pain. This was not sold to Donald Trump, in my opinion, that we'd be headed towards a recession, that the Treasury market would freeze up. As Brad Gerstner said, we still have to finance our national debt. We have $10 trillion of Treasuries to sell this year, and 35% of them are owned by foreign governments. So we are still at the point where we could have a failed auction. They've taken it to that level, and I think that needs to be kind of brought in. So, what's going on in the U.S. Treasury market, and why does it matter? Well, first of all, this has been going on literally since Donald Trump. You started to get the acceleration, and I want to make sure people realize Trump takes over. This is China's gold holdings, and this is their treasury holdings. So they've been reducing their treasuries for quite some time now, and they've been increasing gold, not just because of Donald Trump. Remember, this is coming out of his first term. This is preparation to some degree for Trump taking over once it became evident, but also once the U.S. in here decided to weaponize the dollar, the reserve currency status, which started with sanctions over Russia. China decided to do what any smart business would do. If you're going to freeze our assets, we're going to move as much as we can away from the U.S. So this has been going on. The pressure has been growing, but there's also another side, which is the fiscal and debt side of the U.S. has Moody's, the last one not to move it from AAA rating. We're getting close, and Moody's is going to downgrade the U.S. maybe this year. And part of the issue is because in the U.S., since the pandemic, this is just an interesting chart that was in I think it was the IMF. This is the OECD in terms of the global debt report. This just shows how much, these are the countries over here, larger increase in terms of how much became short-term bills. So we've talked about how the U.S. has to borrow in the short term. That is the issue that comes up. So Besson said he didn't want to come to the market and hit the market on the long end with restructuring. He wanted to get the deficit in check. All these master plans, they wanted to have a slowdown in the economy, move the rates lower, and then they could go out and sell 10-year debts when yields were in a better position. Well, now you've got yields at the top end of the range, and we have no liquidity left. And the U.S. still has to finance itself with short-term bills, which means rolling them over. So the situation in terms of the tariffs and what's happened, there's no way now that they can sell 10-year bonds. There was some talk this week that in the White House, the chatter around super bonds is starting to grow up as part of the negotiations. I would not be surprised. But in the end, this all ends up being printing. This all figures out some way to deal with a situation that you cannot unwind debt to GDP. And that's why if you want to go read something, for everyone who, I heard an argument this week at a dinner about how we really got out of the debt from World War II. I think people need to go read the International Monetary Forum. It's amazing how many people are quoting history in terms of getting out of debt at a time when we are still printing money. The same people never bring up Bitcoin. They never bring up AI except for bubbles. So there is an end game here. My end game as a macro person is completely different. It's related to technology, the democratization of AI, and eventually getting to Bitcoin to deal with productivity. This is the way that people think, which is we have to have a reset or a somewhat of a global recession or a global depression. The problem is we don't have that opportunity. So just to make sure the numbers are there, because we focus too much on the death of U.S. exceptionalism, debt to GDP in the U.S. is 120% in terms of public debt. It's above 100% in France. It's above 100% in the UK. It's above 100% in Spain. Who knows where China's is overall, but it's above 100% when you add in everything. The problem is with over $100 trillion of total sovereign and corporate debt worldwide, this is in the OECD Global Debt Report, 40% of it matures by 2027. So I've talked about an auction, failed auction being worse. This is a global problem, and it shows up in global yields. So we focused on U.S. yields moving higher. The white line here is JGB 30-year yields, higher than at any point since 2003, and just continuing to move. You've got UK in here. That's where this one is. They're the highest in over 25 years. The U.S. is in here as well. You've got Germany. You've got France. Everyone's yields have moved higher, and they've been moving higher for quite some time post-COVID because of the debt that we've taken on the balance sheet. So the global trade restructuring, it's not a U.S. death. It's everyone in the exact same game. And so to sit there and use the headline of that, is there a repatriation into nationalism? Yes, and that is the point of what getting rid of the reserve currency in the state it is, of taking the negative side of it is where we want to reduce the trade side. We want to change everything. And so this is a global situation, and I only bring that up because everyone has to come to the table. It's been too focused on from the U.S. perspective as the problem. This is a global problem that needs to be dealt with, and it was going to be dealt with either in this way or is going to be dealt with Treasury market failures, bond auction failures, which would spread around the globe, and the pressure would start to intensify because rates are already moving higher. So something needs to be done, and I think a rebalancing with some kind of agreement will give people time. But in the end, the only way to deal with this is to continue to print money because that's what democracies end up doing. Is if you don't do it, then we'll vote in someone that's going to help the people. Jerome Powell, I don't need to go through this whole thing, but people want him to cut rates. I just don't think it matters whether he wants to do it or not, but obviously this was a big thing for the market in terms of hearing it. He did mention that on tariffs, the current tariffs under consideration, which again are the China ones, are larger than Smoot-Hawley tariffs, and these are fundamental changes. So everyone's trying to adjust to what's going on. Trump, of course, was angry and basically started saying he wants to get rid of them, and too late, Jerome Powell. And so now you have a Treasury market which already has no liquidity, and now you have threats about firing the central bank president. Again, this is emerging market stuff. This is 100% what I used to see in my days in emerging market. Besant is privately urging caution and trying to be in there and just saying how bad it would be at a time when we don't have the opportunity. So demanding that rates get lower, and it becomes the blame game at this point in terms of what's happening. I just think the pressure is growing, and this is where this week, at the end of the week, or at the end of last week, White House National Economic Council Director Kevin Hassett dismissed the idea of a recession looming this year. This is where the pressure is starting to come. So I've said before, they can't have a recession with a fiscal problem this big, and the reason is Torsten Slok went through this. So everyone who's like, well, he's going to do this intentionally to get us into a recession and then have this, grand plan to come out of it. The problem is, and this is what he brings up, the negative impact of a budget deficit during a recession far outweighs a 2 percentage point decline in rates, which was kind of the game that they thought they wanted, which is let's lower rates. I hear this on the All In podcast too, and then we can refinance our debt, which is just insane in terms of long-term rates, because most of the debt we have is short-term rates, and if the Fed's not cutting, it doesn't really matter. But this is on average how much you lose in terms of your receipts, particularly when 25% of revenues coming in the door are related to the stock market, is 1.3 trillion. So, okay, let's lower rates to refinance, but then we go through it. You cannot get out of this problem with a recession when the deficit is this big. But that's what we're starting to get to. So here is the manufacturing data started to come out this week. This will all highlight just what's happening on the trade and the manufacturing side. This was from the Empire. This is the new orders side, looking out 6 months. So we had seen, improvements going in after the election, expectations, and now we've gone down to levels of the great financial crisis. Philly Fed showed the same thing. Between the Philly Fed and manufacturing, it's your first look for the month on the data of what's happening this month. So it actually came in at a minus 26.4 versus estimates of 2.2. So a massive drop off of 38 points, 39 points. Earnings revisions for S&P 500 firms continue to move sharply lower. Again, very similar point to the shutdown of the economy on a global basis. These are global revisions, which are continuing to go lower. So this is a weekly number, and we had a massive move lower at the beginning of April. It's continuing. This is usually associated very closely with the manufacturing side. Within the market, the S&P has bounced off the lows and is back up here, but we got what I use as the benchmark for when the economy has actually hit a level that is fine. The alarming part should be for people that the reason I brought this up is we made new lows in the equal weight consumer discretionary versus consumer staples. So the economy, the way they're discounting it from the consumer, continues to collapse. Last time we saw anything like this, we saw this bounce here in 22. We saw this come down and make new lows, and eventually the S&P followed. If this doesn't turn back higher, which is only going to happen if we get any kind of significant improvement in tariff or liquidity comes and changes the picture here. If not, the S&P is going to go retest the lows shortly, just because the economy is freezing and there's been no response yet. So, in terms of the economy and how quickly it's freezing up, Ryan Peterson should be on your must. Actually, the two people I'll do, Craig Fuller and Ryan Peterson, should be on your must watch thing. Anthony Pompliano and I both talked about him this week as the two people, and that's because trade has become the most important thing, which means shipping has. And Ryan Peterson runs, I believe it's Flexport, but he will tweet and goes through it. So thousands and millions of American small businesses, including mine, will go bankrupt this year if they don't change. He goes through, he's got a long thread. You've got small businesses now reaching out and threatening or suing Trump over the tariff authority. This is the pressure part of things. We're trying to help small businesses across the country, and Walmart, as always, what happens is Walmart will just keep their prices at the level they were. They will take losses for as long as this goes on. Small businesses won't have the same opportunity, so Trump's master plan of helping small businesses becomes an issue because the bigger places that have access to capital and can stockpile stuff, they will just keep their prices down. As small businesses go out of business, Walmart will buy up the inventory from them. This is not the way to handle things in terms of trying to help out smaller businesses. So this is where one of the issues is, and this is the part of the thread. Just to highlight from Ryan Peterson, in the week since tariffs hit, ocean freight bookings from China are down 50% across the industry. He goes through and says that's about $1 trillion of economic activity because of the leverage on this, meaning there's about 460 to $550 billion of Chinese goods. Those Chinese goods come in at wholesale prices, then they get sold at 3 times that. That's where his $1 trillion of activity is wiped out. His point is there's leverage in where we get things from China as imports, and then what we sell them at here, the transaction costs on that are much higher. Craig Fuller, another person on the trucking and shipping side. Many truckers I've spoken to don't realize how quickly container volumes have collapsed. You're talking about stuff that only compares to COVID. And there's no other way around it. You're going to see a significant drop-off. And already Mack Trucks announced layoffs in Lehigh. So you're going to start seeing the repercussions in terms of layoffs. And this is the main point that I've said to people, and I really went through it at a breakfast. So historically, when we've gotten up to 50, we did get up to 50 on the VIX. This is a monthly chart, so now that we've come back down here, this is where it is. But this is overlaid with the weekly jobless claims. And what I said, and what I'll repeat, saying, there are no such things as recessions anymore since this period. The economy's changed, the job situation has changed. Every single time we get recession fears, 22, whatever, it's been the jobless claims that have stayed stable that just don't show anything. They've been at the same level here. And remember, this is weekly jobless claims. The U.S. population from this point to here has increased, and it's clearly increased since here and here. These numbers relative to the size of the economy are minuscule. And that's why there's no such thing where nurses are not losing their job because of this. Will some truckers lose their jobs? Yes. Will 250 people? Will they be able to go out and get a job if they want one? Probably. The gig economy allows for people to do that. They can't make as much money, but if you can go get another job at Uber tomorrow, you technically have a job. And that's the ability for people to go get jobs. They can't make everything of what they were making. It does lead to wage cuts. It does lead to softer employment. I've shown that the economy has seen much softer employment for the last 2 years since 2022, and that is because the higher rates have hurt smaller businesses. We've seen that with small caps. Now you've got tariffs, which, again, are going to hurt small businesses and lead to more people being forced into this gig economy / consultant type work, which is where 50% of the people in the country are. So you have a completely different makeup of the economy, but as long as transactions are happening, you won't see this go higher. The problem is if you freeze it, just like what happened here, you will start to see it inch up. Imports are only 15% of the global economy, so this is not going to freeze the entire thing, but people, if the government's looking and wants to see no job losses, they're going to start seeing some rise in weekly claims every week that this continues, I think it will go higher. Here are the claims relative to 2's 10 yield curve. You have the yield curve now steepening, which historically has meant we're heading into a recession. Just like you did in '07, we ended up in a recession. 2000, recession in here. 90, we were in one already in here. So it's highly likely we're in some sort of a soft recession right now. The question is, will they let the jobless claims go higher and become a harder one? Housing market is now forecast to be down by Zillow. This is a dramatic shift from where it was. We've been seeing the housing market soften, but it was localized to parts of the economy that probably had the biggest bubble. Well, now, as people are worrying about their jobs, you're going to start to see the housing market become more of a story as well. The bigger pressure to me is going to come from inflation. Everyone has this debate. You're clearly seeing deflation right now in terms of the stock market, but this was a great thread or attend here. Parts of the economy are in a sudden stop. This is what we just went through. Trump has proudly broadcasted the low February and March inflation prints, and today he complained Powell was not cutting rates, arguing oil and grocery prices are going down. Inflation is what kills politicians. Here is where we have now the fixing run, which basically means the market expectations of where the CPI report release will be for April. So 35 basis points, 0.35. So let's say you could have a 0.4 print, hanging around a 0.4 print here, and then in June, 0.5. So I highlighted these because this is the thing that kills. This would be an annualized rate of 6%. If these come in at 0.35, 0.35, and 0.5, you're dealing with approximately at this point something that will be close to 5 to 6% in terms of an annualized number. And even though they have the forecast coming down, this is not going to be the focus of the market. The market will focus as they have. So the pressure would grow on the inflation side as well. And we already have him losing on pretty much all of now. And this is, again, the most accurate pollster in 2020 and 2024. You're getting to the point now where on every issue pretty much across the board, it's worsening from where it was. And that's kind of the issue as to where going. You have to imagine that immigration has even worsened. And this had been an improving thing in March. So on the approval side, he's losing things at this point, which means the midterms become a bigger issue. So the economy and the pressure is growing. And that's why as people extrapolate, and as you hear all these macro people talk about there's a guaranteed recession, this is what's going to happen, this is what's going to happen. We are at the pressure point now, and this is when the administration has to do something. Asset volatility. So I created a new thing, the white line here, which takes into account fixed income vol, currency vol, and equity vol as one component, which I think is going to become important. And the reason is because the only thing that hasn't moved yet is junk spreads. I mentioned that the market's completely frozen. One of the reasons that junk spreads haven't risen is they can't sell them. And they learned in COVID, if you sell them, then you're not going to be able to buy them back. So just like it is with labor, where they don't want to fire people because it's hard to hire them back, the junk market's there. But you're going to start to see this filter through every week, in my opinion. The only question is whether it be small amounts or big amounts. That'll get people more bearish. The issue is we've already seen a second derivative change in policy. We've already seen a second derivative change in terms of how do we deal with the bond market. They're trying to find ways. There's talk about them putting together a task force to deal with the next couple weeks in terms of the trade side in the event that they can't come to a deal. The main point is for everyone out there, the upside is capped without trade deals, but at the same point, you're going to have him try to announce things to get people optimistic. But the economy and the pressure from the liquidity in the market is growing every day. One final thing on this, again, I want to focus on things 1 year out because even if we do go lower, I don't think they can. I know they can't handle a recession, so there will be a deal that gets done. The question is, will the deal get done with the S&P at 5,500, 5,300, 5,200, 4,000? I still want to be buying dips as opposed to selling rallies, but I want to be buying dips below 5,200, closer to 5,000. And that's where I think investors who are looking to put money to work should be looking to do it. In terms of the homework that comes in, again, the AI side, this was a big thing, didn't get a lot of press, but Google came out and said they're still doing their $75 billion this year in AI. NVIDIA bringing stuff back to America. Obviously, they were down this week on the back of the $5.5 billion release in terms of the H200s and not being able to do things in China. Again, all this trade stuff is temporary stuff. I just want to focus on the structural side. Eric Schmidt, who I always mention on this, spoke, predicts AI sprint towards superintelligence could put smartest human in every pocket in 6 years. I want to remind people this because this is where productivity boom happens dramatically, and that's what's going to happen unless we go into a depression. You're going to have the AI accelerate no matter what. AI has grown beyond human knowledge, says Google's DeepMind unit. A new agentic approach called streams will let AI models learn from the experience of the environment without human prejudgment. I listened to a podcast with I forget his name, who spoke about this from Google DeepMind. It was amazing to listen to, just in terms of we've left the LLM side of basically consuming US or human knowledge, and now we're getting into the environmental side or the experiential side where it learns from what it's seeing and what it's feeling, and that's exactly what is being said here. So the full self-driving, just cameras and the Tesla chip. So it's learning now through cameras as opposed to sensors. So as opposed to just seeing that a tree is there and knowing that it needs to avoid it, it's actually learning. And this is an important step in terms of the inference and reasoning side and the ability to take this to the next level for humanoids. One negative, and this again is, in the case of if we want to compete with China, actuators, the muscles of humanoids, you can't get them. The Chinese are the only place in the world right now that makes them. So you're going to have to go backwards in the competition for humanoids, which is not just for, making stuff in your home, but it's also for military and things along those lines. So we've run to a point where you're going to, hurt yourself from the trade situation in terms of competing with China, which is another reason why the pressure is just growing. At the end of the day, and Jack Mallers, who's, a famous person on the Bitcoin side, at the end of the day, no matter what anyone tells you, their only solution is to print money. I could not agree more. They have to do that, and that's already happening. So here is the global liquidity. People are not focused on it. It's ripping higher, not just because the dollar is weakening, since this is a dollar chart, but it's also going up because China's adding liquidity. Europe's adding liquidity. They're going to build out the fence. The U.S. is now going to have to add liquidity to the system. And Bitcoin has held up extremely well during this period. I've talked about my favorite trade for the year, but I want to just highlight, I tweeted this week. This is critical for people looking to what they have to invest in next. This is Bitcoin relative to the Mag 7. I've said repeatedly that once Bitcoin starts to become the only innovation that has a moat, and the Mag 7 now realize they no longer have a moat in terms of AI, which I thought would disrupt this business, but the trade situation where 50% of their revenues come from overseas, where people are reducing their ownership in U.S. assets, the Mag 7 are they're no longer going to have a multiple that is high, and I thought their multiple was too high relative to the reality of their growth. We knew they were spending lots of money, but this chart just shows that over the last 3 times that the S&P had a correction of at least 20%. So in 2018, S&P goes down, which is the yellow line. Bitcoin versus the Mag 7 underperforms by 46%. Back here, down by 30%. Down here, 2022, again, 40 plus percent decline in Bitcoin relative to the Mag 7. Here we get a 20% decline in the S&P, and Bitcoin versus the Mag 7 since that day is up 13%. So if you're a long Bitcoin, short the Mag 7. All of those themes about what does Bitcoin do, what do, they are not exposed to the global situation. I will keep saying it. Go spend the week necessary to learn more about history on monetary debasement and what actually happens, and don't believe it has to end with a depression. We have a printing press, but more importantly, we're entering a world of artificial intelligence. We have never seen this before, where people don't need to work. This is a completely different situation than the history book. So all the history people, all the people I've been at dinners with that have regurgitated that this happens and always happens and this is what has to happen, this is not the same time. This is when the digital economy takes over for the physical economy and they merge together. Volatility on the two of the assets. So people were worried about Bitcoin volatility. So far this year, last 60 days, 47 vol for the Mag 7, 53 vol for Bitcoin. Used to be different in the past, but this is not an asset like it was in the past. Stable coins, the network effects for Bitcoin. I've talked about this, much bigger picture. I don't feel most people understand this. Fed Powell reasserts support for stablecoin legislation. I just want to repeat that. So Donald Trump and Jerome Powell agree on stablecoin legislation. Everyone needs to go read about what stablecoins are and make sure they understand it. Italy's finance minister warns U.S. stablecoins pose bigger threat than tariffs. These are massive statements. People need to go spend the time on it. Stablecoin growth could drive $400 billion a year into T-bills. They are already one of the top 20 largest owners of Treasuries, and it will continue to grow. And as I've said repeatedly, we will end this podcast, this report here. Governments, central banks, and the wealthy people of the world are talking about how the world should end without any regard to what the 7 billion people on the planet who are going to benefit from the democratization of AI, which lets the entrepreneurs go up, but also gives the ability with stable coins to transact at lower costs. It opens up the banking system to those 7 billion who can't get into a bank. They get to participate in the global capital system, and they only want to make thousands of dollars, not millions of dollars. And when they make that money, those 7 billion people are in countries where they trust the US dollar more than the rest of the world in terms of the currencies. So the stable coin, that's why dollar stable coins, it's 99% US dollars, and that's why Italy said stable coins pose a bigger risk. People around the globe, not the governments, not the 1%, they might sit there and be scared and be moving their money to gold, but around the world where people are going to participate, stablecoin leads to more people participating, it leads to more democratization of entrepreneurship, and it will lead to more money going into the digital economy, which benefits both the US dollar and it benefits Bitcoin. So for the death of US exceptionalism, stable coins are going through the US administration at the same time that tariffs are going. This is a big switch towards the digital economy. It's time for everyone to do their homework on Bitcoin. That's it for this week. See you guys next week.